Let me start with a simple question. If a bank approved you for a large loan tomorrow, would you feel powerful or quietly pressured? Take a moment and answer that honestly, because debt does not only change your balance sheet, debt changes how you feel. You may recognize this experience. You apply for a loan. The bank approves it. The monthly repayments look manageable. The spreadsheet works. You tell yourself it fits comfortably within your income. Now imagine this. You take out a mortgage based on today's salary. The payments feel fine. You may even feel slightly proud that you qualified. But 2 years later, something changes. Interest rates rise. Your employer restructures bonuses. A family expense increases. The payment itself has not changed dramatically, but your margin has. What once felt strategic now feels heavier. On paper, you are still affording it, but internally something has shifted. Your flexibility has narrowed. That is not always an income problem. Very often it is a structure problem. Debt is not dangerous simply because it exists. Debt becomes dangerous when it replaces margin instead of sitting inside it. Let me explain that more clearly. There are two very different types of leverage. The first is calm leverage. The second is fragile leverage. Calm leverage means you borrow while still maintaining breathing room. You can absorb interest rate changes. You can survive a temporary income dip. You maintain liquidity. You retain optionality. Fragile leverage looks similar at the beginning, but structurally it is very different. Fragile leverage works only while everything goes right. If income slows, or rates rise, or expenses increase, pressure appears immediately. Both situations involve debt. Only one preserves stability. The difference often becomes visible only under stress. Later in this video, I will explain the most overlooked factor in leverage decisions. Interestingly, it has less to do with interest rates and more to do with identity. But first, let us examine the first behavior that creates fragile leverage. The first behavior is borrowing at the edge of affordability. Affordability on paper does not equal resilience in reality. For example, if loan repayments consume nearly half of your take-home income, small disruptions feel magnified. A missed bonus, an unexpected expense, a rate adjustment. Suddenly the emotional landscape changes. You may technically afford the loan, but your flexibility has disappeared. One useful protection is calculating repayments based on conservative income, not peak income. You can also test repayments under higher interest assumptions. Maintain liquidity after taking the loan, and avoid synchronizing large leverage decisions with other major life commitments. Conservative structuring may feel slower, but it is often stronger. The second behavior is using debt for consumption disguised as investment. Not every appreciating asset is a productive asset. For example, financing a lifestyle upgrade because it holds value does not necessarily increase income. Borrowing for lifestyle inflation increases fixed obligations, but it does not strengthen your financial structure. Productive debt typically improves cash flow or reduces costs. Consumptive debt increases obligations without strengthening resilience. A simple question can clarify the difference. Does this debt increase optionality or reduce it? The third behavior is underestimating volatility risk. Debt amplifies outcomes, including negative ones. Property values fluctuate. Business revenue fluctuates. Interest rates fluctuate. If your structure cannot absorb those movements, leverage magnifies stress. This is why experienced investors stress test leverage decisions. They model downside scenarios. They maintain liquidity, and they separate optimism from obligation. Leverage without stress testing is often optimism disguised as strategy. The fourth behavior is layering leverage during expansion phases. When conditions feel strong, leverage feels safer. For example, rising asset prices, easy credit, growing income. Each additional loan may feel justified individually, but collectively they reduce resilience. This is why leverage decisions should be evaluated across total exposure, not loan by loan. Strong cycles often disguise structural risk. The fifth behavior is confusing ambition with leverage necessity. Ambition does not always require borrowing. For example, a business may scale faster through debt, but that speed may come at the cost of flexibility. Slower growth funded through equity or retained earnings may feel less dramatic, but often proves more durable. Speed without structure creates strain. Durability often creates freedom. The sixth behavior is ignoring psychological leverage. Debt affects cognition as well as cash flow. High debt loads can increase background stress. They can narrow decision making. They can reduce risk tolerance in other areas of life. If debt consistently affects your sleep, focus, or emotional stability, its behavioral cost may exceed its financial benefit. Calm leverage should still feel manageable under moderate stress. Now we arrive at the most overlooked factor: identity leverage. Sometimes borrowing becomes tied to identity. Taking large loans may feel like confidence. Avoiding debt may feel conservative. But leverage is not identity. It is structure. The healthiest leverage decisions happen when ego is separated from obligation, when resilience matters more than symbolism, and when borrowed scale does not define success. Let us summarize the core ideas clearly. Avoid borrowing at the edge of affordability. Avoid confusing consumption with investment. Avoid ignoring volatility risk. Avoid layering leverage during optimistic periods. Avoid equating ambition with debt necessity. Avoid ignoring the psychological cost of debt. And protect identity margin when making leverage decisions. Debt can accelerate wealth, but it can also accelerate instability. Calm leverage increases optionality. Fragile leverage reduces it. If this perspective resonated with you, comment the words calm leverage. It signals that you are building strength before applying force. And if you value calm, structured frameworks for building durable financial systems, consider subscribing. In the next video, we will explore how financial simplicity often outperforms financial complexity over long periods of time. I will see you there.